Welcome to the Deep Dive. We sift through the noise to get you the key insights, and today we're diving into Garmin. They just released their Q2 2025 numbers, and there's a fair bit to unpack from the earnings call and the press release. So our mission here is to pull out what really matters, give you those aha moments about where Garmin stands and where they might be headed. It's more than just fitness trackers these days, right?
Oh, absolutely. From aviation cockpits to marine navigation. And yeah, it was a seriously impressive quarter for them, seeing double-digit growth basically everywhere you look, all the segments, all the geographies. That's pretty remarkable, especially with the kind of mixed economic picture we're seeing elsewhere. It really signals some fundamental strength.
Okay, so let's unpack that overall financial picture then. Garmin delivered, you said, outstanding Q2 results. What are the headline numbers that really jump out?
Well, the top line, record consolidated revenue, we're talking over $1.8 billion.
Yeah, 1.8 billion.
Yeah, and that's a 20% increase compared to last year. And it flows down too. Record second quarter operating income, $472 million, which is up 38%.
38% increase in operating income? That's huge.
It really is. Shows strong leverage. Gross margin expanded to 58.8%, operating margin to 26%, and pro forma earnings per share, $2.17. That's a 37% jump. And like I mentioned, it wasn't isolated. Every single business segment saw a double-digit sales growth. That's pretty rare.
Okay, every segment. And geographically,
Yeah.
it's concentrated anywhere.
Nope, strong across the board there too. All three regions showed double-digit growth. EMA actually led the way with 25%, Americas saw 19%, and APAC was up 16%.
That is impressive. Really widespread strength. So what does this all mean for, the rest of the year? Are they feeling confident?
Definitely seems that way. They've updated their full-year guidance, and they've raised their previous estimates. Garmin's now anticipating approximately $7.1 billion in revenue for the full year and $8 per share in pro forma EPS. So yeah, raising the outlook suggests they see this momentum continuing.
Okay, that makes sense. But, it's not just about the numbers, is it? There was
No.
a really interesting strategic move announced, too. Garmin's acquiring a company called MYLPS. Tell us about them. Why is this a big deal?
Yeah, right. MYLIPS. They're a global leader, really, in timing and performance analysis. Think athletic events, motorsports, even equestrian competitions. Their customer list is, well, it's top tier. Events like the Boston Marathon, Ironman races, even Formula One, they provide the tech for timing those big races.
Okay, Boston Marathon F1. That's serious stuff. So
Yeah.
what's the strategic thinking here for Garmin? Why buy a timing company?
Well, it's actually a very clever move, I think. The goal is to merge the Garmin device experience, your watch tracking your training runs with the official timing and race management tech. So it creates this seamless experience for their passionate customers, right? From training all the way through to crossing the finish line and getting their official time.
Ah, I see. So bridging the gap between personal tracking and the official event results.
Exactly. It provides a really comprehensive view, and, it also expands Garmin's addressable market. They can now integrate that training data with the official race results. It makes the whole ecosystem stickier.
Yeah, that sounds like a really natural fit, actually. Is this factored into that updated financial outlook you mentioned, the cost and the potential revenue?
Yes, they confirmed it is. The acquisition costs and any expected revenue contribution from Aliapelas are already fully baked into that new $7.1 billion revenue and $8 EPS guidance for the full year.
Got it. Okay, so strong numbers, a strategic acquisition. Let's break down where this growth is actually coming from, segment by segment. Where's the real heat?
All right, let's do it. First up, fitness. And this segment was, frankly, outstanding. Revenue jumped 41% to $605 million.
41%. Wow, what's driving that?
Mostly the strong demand for their advanced wearables. They launched some key new products. You've got the Forerunner 570 and 970 new running and triathlon watches with more training features, personalized coaching plans. They also brought out the Venu X1, which is an ultra-thin smartwatch, nice big 2-inch display, more fashion-forward maybe.
Right, trying to broaden the appeal beyond just pure sport.
Exactly. And they also launched the Index Sleep Monitor, their first smart sleep band, and some new cycling tech like the Tax Alpine Gradient Simulator and a Varia headlight with a 4K camera built in. But here's a really key point they made. The growth isn't just repeat buyers. They're seeing stronger growth from new users coming into the Garmin ecosystem.
Okay, that is significant, pulling in new people.
Yeah, suggests they're expanding their market share. So for fitness, they've actually raised their full-year growth estimate now to 25%.
25% for the year in fitness. Okay, what about outdoor? That's usually a strong one for them, too.
Still strong, yeah. Revenue there increased 11% to $490 million, mostly driven by their adventure watches, like the Fenix line, presumably, though they highlighted a new Instinct 3 Tactical Edition. That one's got an AMOLED display now, metal bezel, flashlight, and even a specific rucking activity profile.
Rucking, like hiking with a weighted pack.
Exactly that. It's a growing fitness trend. They also launched new Tread 2 all-terrain navigators for off-road vehicles. For outdoor, though, they're keeping the full-year growth estimate at 10%. They expect things to moderate a bit after the big Phoenix 8 launch anniversary last year, which set a high comparison bar.
Makes sense. Okay, moving on to aviation. How did that segment perform?
Aviation also had a solid quarter, revenue up 14% to $249 million. That growth came from both OEM installations in new aircraft and aftermarket sales. A nice little highlight. Embraer named Garmin a top supplier for the 10th year running.
10th year, impressive consistency. Any big product news?
Yeah, some really significant stuff, actually. They launched the G5000 Prime Integrated Flight Deck, which is for larger Part 25 aircraft, think business jets. It's a major cockpit upgrade. They also got FAA approval for datacom capabilities in their GTN 750 iVi Navigator, which brings modern digital communication like texting with air traffic control to the aftermarket. Very cool. And they introduced Smart Charts, context-specific georeference charts for approaches. Plus, Garmin Autoland got certified on the Cirrus SR G7 Plus series.
Autoland on a piston aircraft. That's a first, right?
It is, yeah. First piston-powered plane with that autonomous landing safety system. Huge deal for general aviation safety. So for aviation, they raised the full-year growth estimate slightly to 7%.
Okay, 7% for aviation. What about marine? How are the boaters doing?
Marine was up 10%, hitting $299 million in revenue, primarily led by chart plotters. New gear there included the GPS MHA 15x3 chart plotters, notable for their ultra-wide display, and the Quadix 8, their high-end smartwatch for mariners. Interestingly, they mentioned the marine market has shown resilience and stability, actually doing better than Garmin themselves had expected earlier.
So boaters are still buying gear.
Seems so. They raised the full-year growth estimate for marine now to 5%.
All right, 5%. That leaves auto OEM. How's that segment shaping up? It's been a bit of a challenge historically, hasn't it?
It has, but showing positive signs. Revenue increased 16% to $170 million. That was mainly driven by higher shipments of their domain controllers to BMW. In fact, they shipped their 1 millionth BMW domain controller from their U.S. facility this quarter. Milestone.
1 million units to BMW. That's substantial volume. Still losing money, though.
Yes, but the operating loss narrowed quite a bit, down to $10 million. So progress on profitability. And they mentioned they're making good progress on their next big auto OEM program, which is set to launch in 2026. Based on this, they've raised their full-year revenue growth estimate for auto OEM to 10%.
Okay, 10% growth projected there. That's quite the turnaround story unfolding. So we've seen growth everywhere, but achieving these results isn't just about sales. How are they managing the other side of the equation? Things like expenses, tariffs, currency fluctuations.
Right, good question. Operating expenses were up 14%. They said that was mainly due to personnel costs, hiring in R&D and sales and marketing, and also costs related to the MYLPS acquisition, so investing in growth. On tariffs, the impact was actually lower than they'd budgeted for, which helped.
Oh, that's a positive.
It was, but it was sort of offset by unfavorable currency impacts on the cost side. Specifically, the Taiwan dollar got stronger, making products manufactured there more expensive. It's worth noting, though, there's currently no tariff on wearables, which is obviously a huge category for them.
Right, that's key.
Yeah. And interestingly, overall, foreign currency movements actually had a favorable impact on their top-line revenue this quarter. Swings and roundabouts.
Okay. And what about their cash situation? You mentioned free cash flow was lower this quarter because of inventory buildup. Any concerns there?
Well, they ended the quarter with a very healthy cash pile, about $3.9 billion in cash and marketable securities. So plenty of cushion. Free cash flow was $127 million, yes, lower than last year, but they explicitly said the higher inventory was a strategic choice.
Strategic how?
To support the strong customer demand they're seeing, and also as a bit of a hedge against potential future tariff increases. Build up stock now, just in case. They're still projecting about $1.2 billion in free cash flow for the full year, so they expect it to pick up.
Okay, that makes sense. And are they returning cash to shareholders?
Oh, yeah. They paid out about $173 million in dividends this quarter, and they bought back $67 million worth of their own stock. There's still $143 million left on their current share repurchase authorization, which runs through December 2026. And the board just set the dividend payment dates for the next year or so, keeping it at $0.90 per share quarterly through March 2026. So consistent returns are clearly part of the plan.
Seems like a very intentional approach to managing things. You mentioned new products driving growth. What does their pricing strategy tell us? Are they just hiking prices?
It's actually quite interesting. They emphasize they haven't done significant price hikes on existing products. Instead, their strategy is really about innovation. They introduce new product lines, pack them with advanced features, new utility, and those command higher price
So
points.
selling new value rather than just charging more for the same thing.
Exactly. They called it a 1-2 strategy. Promote the established products based on their value proposition while offering these innovative new products at higher price points for customers who want the latest and greatest. It suggests customers are seeing the value in the new features, are willing to pay for them, which speaks volumes about their R&D and brand strength.
Right. Looking ahead then, beyond the current product lines, what's their thinking on some of the emerging tech buzz, like health wearables specifically, and maybe even smart glasses?
Okay, so for health wearables, they sound very bullish. Their philosophy seems to be you can't change what you can't measure. They see huge potential in wearables for managing health. They feel their wide range of products caters to different needs and lifestyles, and they see themselves at the forefront of, sensor technology and turning that data into actionable health insights. It's clearly a big focus.
And smart glasses, are they jumping on that bandwagon?
Much more cautious there. They're taking a wait and see approach. They pointed out that, smart glasses have sort of come and gone once already, and there are still real concerns about public perception and usability. For now, they seem to believe that traditional wearables, like watches, still offer very strong utility for what their customers need. So, no big push into glasses planned, it seems.
Interesting contrast there.
Hmm.
And one last area, subscription services. We hear a lot about recurring revenue. Is that becoming a bigger piece of the pie for Garmin?
It is growing, yes. They confirm subscriptions are expanding across all their segments. Things like their InReach satellite communication service and outdoor, the Bounce watch service for kids, Garmin Connect Plus features and fitness, and various data services for aviation. It's not yet big enough to hit their 10% disclosure threshold, so they don't break out the specific numbers, but it's definitely part of the strategy, adding those recurring revenue streams alongside the hardware.
Okay, so putting it all together then. Record revenues, that strategic MYLAPS acquisition, innovation firing across all cylinders. What really stands out to you from this deep dive into Garmin's quarter?
For me, it's their consistent ability to innovate and essentially create new value and new product categories. They aren't just relying on raising prices on old stuff. That adaptability, that focus on differentiation is allowing them to navigate this, let's say, dynamic economic climate really well, and crucially, keep attracting new customers into their world. It just shows a very robust business model.
Yeah, absolutely. So as you think about Garmin's future, here's something to mull over. With these investments in health data, in race timing through MyLivePS, how might they further reshape what we think of as connected living? Could they push beyond just navigation and fitness tracking into, I don't know, whole new areas of managing our personal performance and well-being?